Hey there, Mad Money viewers! Today, we're diving into the exciting world of short selling. Think of it like this. You believe a stock is going down. You borrow shares of that stock from your broker and sell them at the current market price. Your hope is that the stock price drops. If it does, you buy back the shares at the lower price and return them to your broker. The difference between your selling price and your buying price, minus any fees, is your profit. But remember, if the stock price goes up instead of down, you'll lose money. In the next section, we'll walk through a real-world example of a short trade. Let's say you're a savvy investor and you're feeling bearish on a tech giant like, say, Fruitful Systems. You believe their new phone is a flop and their stock is headed for a fall. So, you decide to short Fruitful Systems. You borrow 100 shares of Fruitful Systems, currently trading at $200 per share, and sell them, netting you $20,000. A few weeks later, your prediction comes true. Fruitful Systems stock plummets to $100 per share. You buy back the 100 shares for $10,000, return them to your broker, and you've made a cool $10,000 profit, minus any fees. But if Fruitful Systems stock soars to $300 per share, you'll be out $10,000 plus fees. That's the risk of short selling. Your losses can be potentially unlimited. Short selling can be lucrative, but it's not for the faint of heart. The potential for unlimited losses is a very real danger. When you buy a stock, the most you can lose is your initial investment. But when you short a stock, your losses can theoretically climb infinitely. Another risk is the dreaded margin call. If your short position moves against you, your broker can demand more funds to cover potential losses. Then there's the short squeeze, where a heavily shorted stock rises, forcing short sellers to buy back shares, pushing the price even higher. Short squeezes can be brutal, inflicting massive losses on short sellers. Short selling is a high-risk, high-reward game, not for everyone. When to short. Timing is everything. So, when is it a good time to consider short selling? Generally, you'd want to short a stock when you have a bearish outlook on its future. This could be due to factors like negative news, industry headwinds, or overvaluation. Short selling can also be used as a hedging strategy to protect your portfolio against market downturns. Timing is everything when it comes to short selling. Shorting too early can mean missing out on potential gains if the stock continues to rise. Shorting too late can be disastrous if the stock price plummets and you're forced to cover at a significant loss. Playing fair rules and ethics of shorting. Short selling, while legal, is heavily regulated to ensure fair and orderly markets. One such regulation is the uptick rule, which requires short sales to be conducted on an uptick or a 0+ tick. This prevents short sellers from driving down the price of a stock that's already in free fall. Beyond legal regulations, there are ethical considerations. Spreading false rumors or engaging in manipulative practices to drive down a stock price is unethical and illegal. Short selling should be based on sound analysis and a genuine belief that a stock is overvalued or headed for a decline. Charting your course. Technical analysis for short sellers. Technical analysis can be a valuable tool for short sellers. By studying charts and identifying patterns, traders can spot stocks ripe for a decline. Indicators like the Relative Strength Index, RSI, can signal when a stock has risen too far, too fast, and is due for a pullback. Breakdowns below support levels can indicate further downside. High volume during declines suggests institutions are selling, a bearish sign. Combining technical analysis with fundamental analysis can increase odds of success. Remember, knowledge is power. Stay informed, stay cautious, and may all your trades be profitable.